Good morning, everyone. Welcome to day 5 of the workshop, Strategic Virtual Financial Reporting for Professionals. Now, we are going to continue from where we stopped. In the last class, we introduced deferred taxation, and we tried to understand and give some level of preamble about deferred taxation in line with the provision of IAS 12. We are able to identify then that deferred taxation is not tax, but rather is a measure or an accounting measure that is made for the purpose of reflecting or capturing future tax consequences of current period transaction and events. Okay, and we said we need that in order to adjust for current taxes so as to reflect the tax impact on financial performance. And we went further to discuss on what gives rise to recognition of deferred taxes. And we said deferred tax is recognized upon having temporary differences. And went further to discuss on temporary differences as differences that arise between the carrying amount and the tax base of assets and liabilities. We also said then that deferred tax, the temporary difference will either be taxable or deductible. Furthermore, we went further to say a taxable temporary difference is a difference that will result in higher amount of taxes in the future, whereas a deductible temporary difference will bring about a reduction in future taxes. Furthermore, we discussed on how can we determine such with respect to assets and liabilities. We said you have a taxable temporary difference in a situation where the carrying amount of an asset is greater than the tax base of an asset, or where the carrying amount of a liability is lower than the tax base of the liability. And conversely, you have a deductible temporary difference when the carrying amount of an asset is lower than the tax base of the assets, or when the carrying amount of a liability is higher than the tax base of the liability. Now we went further to discuss on what is the tax rate that is applicable. And we said first, tax rate represents the portion of the taxable profit that the tax authority want to take as taxes. And that portion is what influences the rate of tax, which means if government is interested in taking half of your profit, it then presupposes that your tax rate will be 50%. If government wants to take quarter of your profit as a tax payable to it, it then means that your tax rate is 25% of it. But again, we said there are different tax rates. Which tax rate is applicable or relevant for the purpose of computing deferred tax? We said we have to look at it from two perspectives. One, from the mode of recovery of an asset or from the settlement of a liability. And for mode of recovery of an asset, we ask ourselves a simple question. The asset in contention that brings about the economic benefit, the realization of the economic benefit, does it arise from usage of that asset or arise from disposal of that asset? That will influence the deferred tax. And we'll give an example. An asset to which economic benefit is realizable upon disposal will be subjected to capital gain tax, which the rate is 10%. For an asset such as PPE, that primarily the economic benefit is expected to be fully utilized from the usage of that asset over its useful life, will generate income that will be subjected to company income tax at the rate of 30%. Furthermore, we said the statutes of the tax law also matter in determining the applicable tax rates. Even though we might have agreed that we use the tax rate for income taxes of 30%, or we agreed that we use capital gain tax of 10%, but we now ask ourselves a simple question. Are we making use of the enacted tax rates, or are we making use of the substantively enacted tax rates? Now, what is an enacted tax rate? An enacted tax rate is simply the ruling, the prevailing, the existing tax rates that is applicable in the current period. While substantively enacted tax rates come into being whenever we have an enacting existing tax rate, but there is a new pronouncement that certain tax rate will take effect from a future period. The new tax rate that is expected to take effect from a future period is what is otherwise known as substantively enacted tax rates. And that is what we are trying to explain, which means ability to ascertain what mode of recovery or settlement are we going to derive our economic benefit, or are we going to utilize the economic benefit, vis-a-vis whether the tax rate is ruling or the tax rate is more or less expected to take effect at a later date. These considerations are what we are going to take into fact in determining the appropriate tax rate to use at every point in time. Okay. Now, we stopped at discussing what is a tax base. Okay. And we said we should consider and go and research further what is a tax base. And this morning, we are going to start from there. What is a tax base? I'll put the floor open for us to discuss what is a tax base. You guys can unmute yourself. Who is the first person to give us a clue? I think Shegun want to talk. You can unmute yourself.
I actually don't want to talk because I didn't participate in the last class and I've not seen the video.
You've not seen the video, or you've not watched the video? They are two separate things.
I've not watched the video.
Why?
Yeah, because I've been very, very occupied throughout the week.
But the video, you'll have created time because it's critical. Because if you don't have the background, you might find it somehow challenging, not something you cannot cope with, but somehow challenging, and it will have been better appreciated if you have watched the video. Okay, who else? Who else? Awajide, I think you want to say something.
Okay, tax base is the total amount of tax of the total amount of the assets or income that is meant to be taxed, like the assets that is meant to be taxed or the income that is meant to be taxed. So the total amount of it.
Okay, who else want to give us a clue? Who else? Anna, your hand.
In addition to what Babajide said, the tax base, I haven't used it to calculate on the total asset or the value of an organization business. It would be used to determine
I think your network is bad.
liability of that.
I think your network is bad. Okay.
So that's what I have.
Okay, thank you. Mr. Ayodele?
Yes, sir. Can you hear me, sir? Good morning,
Yes, sir.
everybody.
Mr. Ayodele, I think you are muted. You are muted.
Okay. Hello,
Yes, sir. You are muted again, sorry. Anne, can you mute?
Hello, can you hear me now?
We can hear you now.
Okay, can you hear me now?
Yeah, but Ayodele is on the line. Can you mute yourself? And you can go on, Ayodele, sir.
Yeah, good morning, everybody. Like the earlier said by one of our colleagues, tax base is the total amount of income and asset that the government is agreed to impose tax on. That's the little idea I have about the tax base.
Okay, thank you very much. Who else want to contribute? Duncan, are you there? Can you put up your camera? For those coming in newly, Enaro, Marian, please put up your camera. Okay, Duncan, we are expecting you to say something. Enaro, can you say one or two things?
Yeah, please, I'm commuting. I won't be able to say much.
Okay, no problem. We'll exempt you. Yeah.
Let me say something, sir.
Okay, Wale.
Yeah, tax base is the value of assets and liability. The value of asset per liability has determined by the relevant tax authority, in which a specific percentage is calculated upon by the relevant tax authority to determine tax payable.
Okay.
Okay, let me add.
Yes, sir.
The tax base is actually the taxable portion of income or profit as calculated by the tax authority after making deduction for allowable and non-allowable expenses, making provision for capital allowances, and the stating figure for the situation. So let me just put like a tax base is from the tax authority point of view, what you are going to be, the total amount of your profit that is projected to tax.
Sorry, let's continue. Now, I think some of us misconstrue these two together. Okay, let's try and pair it together and try to see whether there's a difference between it. Is there a difference between, let me enlarge it. Is there a difference between basis of tax, or what some people may call tax basis, and tax base? Let's start from there. Who can say something about that? Is there a difference between basis of tax, which is tax basis, and tax base? The floor is open. Olawale, start.
When you say the basis of tax or tax basis, you are referring to the rationale, the rationale behind the tax that is to be charged, that is charged. Is it on your income, or on assets, on what have you? But for tax base that we're discussing here, we are talking about the value of the asset to liability for tax purpose as determined by the relevant tax authority. I don't know if
okay, any other person? Madam Oladokun. Madam Oladokun.
Hello, good morning.
Yeah.
Good morning, everyone.
Yeah.
So, to my own understanding, basis of tax. Yes, I can hear you. Good morning, everyone. It's just the reason why we are levying that tax. What is the reason why that tax is coming up? Just like Olawale said, why? Is it as a result of, what do you want to compute? What are we taxing? What is the tax coming on about? Is it for CIT? Is it for EDT? Is it for pay? Then the tax base, that's like the foundation of taxes. So that's my own understanding.
Okay. Thank you. Who else wanted to contribute? Okay. Let me proceed. When you say basis of tax, you are simply talking about the reference value to which tax or tax rate is assessed. What that simply means is this. Examples of tax basis. It can be value of goods. and services. It can be based on turnover or what we call sales. It can be based on production or output. It can be based on profits. It can be based on assets value. etc. Now, for example, the tax basis or the basis to which VAT is administered is the value of the goods consumed and the services enjoyed. For example, we talked about some revenue taxes, which is otherwise known as sales tax. For example, say NCC collects certain percentage, and some other regulators similarly collect certain percentage of the revenue of the operators within that industry. The revenue becomes a basis to which tax is assessed. Production. For example, excise duty. The basis to which excise duty is assessed is the production of goods. For natural resources, it's based on production by lifting out on the ground natural resources, which is based on output. Income taxes, company income tax and etc. are taxed based on profits, which means it's a profit basis that is used to assess income tax. Other taxes are based on value of assets, such as stamp duty for ad valorem, or based on value of documents or agreement involved, and some other things like that, which means the reference point to which tax is assessed is known as tax basis, not tax base. They are two separate things, or basis of tax, which means the reference point to which tax is assessed. But what we are talking about today, what we want to talk about today is that we are talking about tax base. Therefore, the question is, what is a tax base? Now, people have tried to make mention of a tax base. Okay, some misconstrue it, which is the reason why I have to explain tax basis separately from tax base. But in a simple way, I'll tell you that tax base is the amount of an asset or liability for tax purposes. Now, what it simply means is this: the value to which for tax purposes is recognized as the value of an asset is the tax base of that asset. Likewise, the value that is recognized for a liability for the purpose of taxes or tax administration is what is known as the tax base of liability. Let me give you for example. Let us pick a qualifying capital expenditure, that is, asset that qualifies for capital allowance. The tax base of such an asset will be the amount of that asset that is yet to be enjoyed by way of capital allowance, which simply means it is the value, the cost of that asset, less capital allowance already enjoyed. The balance is what you know in Nigerian tax law as the tax written down value. Such a tax written down value, after deducting capital allowance already consumed or enjoyed from the cost, is what we call the tax base of a qualifying capital expenditure. That's what we mean by tax base. Okay, even though in a tax regime or in normal tax assessment, you don't talk about tax base, but we use that as a reference point in accounting. And why are we doing that? It's because in accounting, that same asset and liability are recognized in our books. And in accounting, the amount we recognize those assets and liabilities is known as a carrying amount. Now, the nomenclature we are now giving to that, if it's for tax purposes, is what we call the tax base, which is different from what you know under taxation, which we call tax basis, or basis of what? Taxation. Are we clear? That is that. But now, let us now technically define tax base from the perspective of an asset, and also define it from the perspective of a liability. And the essence of that is that will make us appreciate how do we ascertain the tax base of different categories of assets and different classes of liabilities. Now, I'll share the slide. Now, what is the tax base of an asset? I hope you can see the slide.
Yes.
Okay. Now, the tax base of an asset is simply the amount of an asset that will be deductible for tax purposes against future taxable profits. Now, what it simply means is this. For every asset you have, be it PPE, be it inventory, be it investment, be it receivable, be it cash, and any other form of assets, the tax base of that asset will be equal to the amount of that asset that will be deductible in the future against taxable profits, or for the purpose of ascertaining the amount of tax payable by the entity. Do you get what I'm saying now? And that is it. Now, let me break it down into consequences. The first consequence there is this. If the economic benefit associated with an asset will not be taxable, it then presupposes that such does not have any tax implication, either current or deferred tax. And in that regard, the tax base of such an asset, without wasting time, will be equal to the carrying amount of that asset. And we all know what the carrying amount of the asset is. The carrying amount of an asset is the amount of that asset you have recognized in line with IFRS in the balance sheet of that enterprise. all of those standards that we are discussing or we are still going to discuss, we more or less give us room towards recognizing how do we determine the amount of that asset or liabilities we recognize in our balance sheet, which is a carrying amount. What this signifies is that you don't need to bother trying to determine the tax base of an asset that has its associated benefit totally exempted from taxation. Secondly, it presupposes that whenever you have any asset, no matter the nature of the asset, and such an asset has no tax consequence, do you get what I'm saying now? The tax base of such an asset will be equal to the carrying amount, or because the taxable, the temporary difference will be nil. Now let me try and correct this. I'm coming so that I can relaunch it. Where an asset has no tax consequence, the tax base of such an asset, not liability now, of such an asset is equal to the carrying amount. Therefore, the temporary difference equals 0 or is nil. Do you get it right? And we're going to see that. We'll pick illustration one by one. And this illustration we'll pick one by one will speak volume to the tax I gave you guys last week. Now let's look at the first tax. The first tax here is this. Okay, let me allow you peruse it first, and we'll come and discuss it. I'll give you just 2 minutes to peruse it. Okay. Now, what can you say about what you've seen here? Now, let's pick them one by one. The first scenario says that you have a plan that costs you 20,000 naira. Now, for tax purposes, the plant enjoys tax depreciation. Another name for tax depreciation is what we call capital allowance. Remember, capital allowance is also depreciation in principle. Only there is a depreciation recognized solely for tax what purposes. Now, he has already enjoyed the total tax depreciation or capital allowance for the current and prior years in the sum of 5,000 naira, which means that the tax written down value of that plant will be the cost of the plant less the total capital allowance enjoyed, which is 20,000 minus 5,000. That gives us what? 15,000 as a tax written down value. But again, the tax written down value may not exactly be our tax base. Why? Let us read further. It says that revenue generated by using the plant is taxable, and any gain or on disposal of the plant will be taxable, and any loss on disposal will be deductible, which means there's a tax consequence to that plant that generates that economic benefit. Which then means that in that case, we can now resolve to say the tax written down value of that 15 amount to its tax base of 15. Otherwise, if the phrase here has said, can you see what I'm touching? If the phrase here under the taxable has said it is non-taxable, it presupposes that though the tax written down value is 15, but the tax base will not be 15. Rather, the tax base will be equal to the carry what amount, because there's no tax what consequence. But in this case, there is tax consequence because the associated revenue attributable to that plant is subjected to tax. And that's why we concluded that the tax base is 15. The same thing happens to all qualifying capital expenditure. The reason why you are granted capital allowance is because the benefit that will be generated from those assets will be subjected to tax, which then means that for every qualifying capital expenditure, whenever you come across it, the tax base of those qualifying capital expenditures should be equal to the tax written down value, which you have computed on your capital allowance schedule, where you have deducted all capital allowances from the original cost of that asset. Second one is this, interest receivable at the carrying amount of 3,000 naira. Who can explain what do you mean by interest receivable? What gives rise to interest receivable? The floor is open. Who wants to say something? What gives rise to interest receivable? Because if you don't understand the nature and the class of an asset, it may be difficult for you to be able to ascertain what the tax base is. When you say you have interest receivable and it's an asset, what is it? What gives rise to it?
Okay, let me just say something here. That I'm still on the way.
Yeah.
So interest receivable is an income an interest you have actually recognized in your books, maybe probably prior year, and you have not received the interest in cash, but you have actually recognized it as an income.
Thank you very much. Thank you very much. Now, what it means is this. Probably you gave loan, and loan, you accrue your interest as at when due, but physical cash has not been received. Remember, we use accrual basis, which means whether you have received cash or not, you must recognize your income when it is earned. Upon earning your income, what you simply did was to credit your interest income account, which is a P&L item, and you debited your asset account, which is interest receivable. Now, that's what has happened. Now you have interest receivable of 3,000 that has been recognized. But we are told that based on the tax law, the related interest revenue will only be taxed on a cash basis. What does that mean? Who can explain what that means? When tax law says any interest you earn or you are expecting will only be taxed when it is actually collected. That's what cash basis means. Not when you recognize it for accounting purposes, but rather when that interest enter your pocket or your bank account. That is what it means. Therefore, what is the implication of that? Who can explain? At what point will you tax it? Is it this year that the interest is due and I've recognized it, or next year when the interest is actually received by way of cash from the borrower? Who can answer that question?
Okay, I can just say, can I say something?
Yes, sir.
So basically, it's part of interest, as you just say, it means that it is when the cash comes in that it is subject to tax. So whatever you do at a prior basis of interest, it doesn't affect the tax. It's only when the money comes in. So you receive the money now, you pay tax on it this year. If not, you pay tax.
Therefore, now let me quickly open the schedule we did last week, the analysis we did on the Excel. Okay, I'll use it to explain it, to support my brother, Enaro. Okay, let me share the screen to the Excel. Now, if you remember, we had something here that says non-taxable income. Is that okay? And non-taxable income could include, let me bring it here. Income and I remember earning income is an accounting language, which means it is due. Income earned, but not yet received in cash, but of which it is only subject to tax on a cash basis. What that means, let us assume that here it is 0. Or let me just put it to be 100. Now, what this means here? It means that though you have earned that income, which is part of your 100 million here, it is part of your 100 million here, it is part of this 100 million. But this 100 is such that you have earned it, but because the law says this will only be taxed on a cash basis, which means upon receipt of cash, means that this income will not be recognized for tax purposes this year. Rather, as you take it out of this profit this year, don't rejoice to say, it has reduced my tax. What happened is that next year has now come. And next year is 2021 now, which you have received it as cash. Therefore, that will now come under here. Can you see what you said here? Omitted taxable income. What it means is that in your financial statement this year, that income will not be in your profit or loss. But because you are aware that last year it was in your profit or loss, but you remove it for tax purposes because of cash basis requirement, this year you now bring it here as what? Income received. Okay, it's different from this. I can now come here and say income and in prior year but cash received in current year and which is taxed, which is subject to tax on a cash what? On a cash basis. Let me say it's 80. Which means this 80 now is for last year own that was taken out and which we are now recognizing now for tax purposes. While this one is for this year that will be recognized next year, assuming cash was received what? Next year. Now, that is that. Now, let's go back. Now, what that means in this case, what that means in this case is that if that is the scenario, it then means that the tax base of that asset is zero. Why is it? It's because such an asset does not exist, which means from tax angle, you shouldn't have recognized income because it's a cash basis, which means you have not received that income, therefore don't recognize it what? At all. And not recognizing it at all means that interest income in your books in your tax book will be zero. And interest receivable will also be what? Zero, assuming we keep separate books for accounting and separate books for what? Tax. And that's what it means. Now let's look at the third one. The third one is trade receivable have a carrying amount of 25 million. The related revenue has already been included in taxable profits. What does that mean? Now, what gives rise to trade receivable? I need a key because you must understand the nature of that asset. You must understand the requirement of tax relating to that asset. And that is what we marry together to determine the tax base. Who can discuss? Who can explain? Trade receivable, what gives rise to trade receivable?
I would like to try. Can I go ahead?
Yes, you can.
Okay, trade receivable is when you sell products or services to your customers and you've already recognized the revenue, but the resulting cash or payment has not been received. That is what gives rise to trade receivable.
Can you repeat it, sir?
Yeah, I said when you make sales to your customer or you render service to your customers and you've already credited the amount to your revenue, but the payment due for that service or for that goods has not been received. That is what we debit as trade receivable.
Thank you very much, sir. Now, what did they say here? If we go by the explanation of what our brother has said, therefore, it means you will have recognized revenue, which will have impacted your profits for you to recognize receivable. Now, they are not saying that the related revenue for tax purposes has already been included in taxable profits. What does that mean? Who can interpret that? If they tell you that the revenue you are talking about that give rise to trade receivable has already been factored in arriving at your taxable profit or loss, what does that mean?
Hello, can I try?
Yes.
Okay, so in on an accrual basis, when you want to recognize your immediately, you debit your receivable and you credit your income, which relates to your taxable profit. So regardless of if the customer has paid or not, you have recognized your revenue. So it's when the customer pays, credit your receivable to say that the customer is no longer owing. So at the initial point of sales, you recognize your income, which whenever you're calculating your profit, your taxable profit is also computed.
And now I want you to explain what does that has as impact in your tax computation. You're saying that for tax purposes, that same revenue has been captured or it has not?
For tax purposes, it has been captured. But it's only, when you are, when we're calculating for our tax purposes, we will still reduce our total receivable from it. So initially, you recognize it, but in tax, when you deduct your receivable, when we are calculating, when we are taking our total turnover, we are calculating on cash basis, less receivables to know which exactly was received in that year.
No, I think you're missing it. Who will assist us for that?
Okay.
Who will assist us?
Hello?
Yes, Enaro.
So what I would just add to it is that for tax purposes, I would rather say that it doesn't have any implication for tax purposes. Definitely the future implication for tax purposes. There's no future implication for tax purposes because it has already been taken care of in the present as in the current year. That is the way I understand it. So there's not likely going to be any timing difference.
What is, what simply means that it is contrary to the first one we did on interest receivable. This one too is a receivable which you have recognized income in, but you have not recognized, you have not received cash. The issue there is that for tax purposes now, according to the tax law that they've used, they said whether you receive cash or not, revenue will be taxed in the period that revenue is earned. That means in the period the goods was sold, which means in that case, accounting principle and the tax requirements are in alignment. And if that is the case, it means if they're in alignment, it means the carrying amount of that asset and the tax base of that asset will be the same because they are speaking the same language. Therefore, there's no cause for any difference at all. And that is what gave rise to the tax base to be 25. Now, let us look at that. Who can explain question 4? Who can explain the answer given to it in a layman's way before I come in? I'm waiting.
I would like to try.
Okay, Shegun, yeah, thank you.
One of the consequences you read out for us earlier is that when an asset has no tax consequence, the tax base of such an asset will be equal to 0. And in this question, is saying that repayment of the loan will have no tax consequence. So that means the tax authority is not expecting to deduct tax from the repayment of the loan, and that is why the loan receivable we have a tax base of 10 million.
Now, if you remember here, we said something here. Are you there? Hello? Okay, we said something here that where an asset has no tax consequence, the tax base of such an asset is equal to the carrying amount. Now, what it simply means, what that simply means in this case is that loan Okay, can you hear me now? Sorry for the network. Now, what we are saying is this. A loan that you give out, when they repay that loan, the tax law says there's no consequence on the loan itself, which is the principal amount. The question then is, if there's no tax consequence on the loan when it is repaid, it then means that the tax base will be equal to the carrying what? Amount. And that's what it means. That's why the tax base here is 10 million. Similarly, you have dividend receivable from a subsidiary, and that dividend receivable has a carrying amount of 50,000. Now, who can explain that phrase? Dividend receivable. What gives rise to dividend receivable? What gives rise to dividend receivable? Who can answer that?
Yes, sir.
Yes, sir.
I want to try. It means you will recognize a dividend and the investments we have in subsidiary in our income as dividend earned, but not yet receiving cash. As a matter of fact, the dividend are not taxable. It means the asset has no tax consequence. Meanwhile, the tax base will equal to the carrying amount. That is why the tax base of the dividend is 50,000.
You're 100% correct. Very simple like that, which means now, apart from trying to explain what the tax base of an asset is, I've used some critical nature of asset to explain. And on that basis, we have a better what? Understanding. Okay, now let us move away from there to liability. Now, what is the tax base of a liability? Now, the uniqueness of liability is this. The tax base of a liability will always first equal to the kind amount of liability, subject to a deduction. I repeat, the tax base of a liability will always equal first to the kind amount of a liability, subject to a deduction, if any. And what is the deduction? Provided you have any amount relating to that liability that will be deducted in the future for tax purposes. Which means if a component of that liability will be deducted against future taxable profits, such amount will be the amount deductible from the carrying amount of a liability to arrive at the tax base. Which then implies that if there is no amount to be deducted, it means the carrying amount less is zero. We still give you the carrying amount. And this only occurs in a situation where there's no tax consequence, or in a situation where probably last year you received an income or revenue in advance, of which the benefit you enjoy in the current year, which means you only earn it in the current year. And that income you receive in advance has already been subjected to tax at the point of receiving it, not necessarily at the point of earning it. Therefore, such amount will give rise to such a deduction. Now, let me show you. Remember, we did one analysis before. I'll share the Excel again. Here, we said something here. Where is it? We said something here. You have income received in advance and of which will be taxed on a cash what basis. Now, what happened is this. Last year, I received rent for 2 years. And upon receiving rent for 2 years, in my books of account, I'm only going to recognize rent of 1 year as my income and defer the rent for the second year as a liability, which means I have rent received in what? Advance. Now, what does that give us is that, for example, if the tax law says that rent received are taxed in the year they are received, which means renter income are taxed on the cash what basis. What that means is that though I've received 2 years, but I've only earned 1 year, the tax authority will still collect rent, tax on the 2-year rent. The reason why sometimes the tax law might do so is that, one, tax law want to collect money immediately because by next year you might have finished all the money and you might not be able to meet up. Or again, government always prefer that the bed at hand is more desirable than 2, 3 that are in the bush that you might not be able to lay your hands on. Therefore, if that is the scenario or this, the case, what that means invariably is that I have paid tax for the 2 years rent at once last year. This year, such rent will not be what? Will not be, the tax will not be charged on the rent this year because it will be like a double charge. And that is what we are saying. Now, and once you look at that, that gives us a need for us to assess what is likely going to be the correct tax base of such a rent. Now, let us go back. Now, we said when revenue is received in advance, the tax base of the resulting liability is the kind amount less any amount of that revenue that will not be taxable in the future what? Period. Now, let us now use this understanding here to answer these following questions. I also want us to look at these 5 and we'll now analyze it one by one. We have 2 minutes to look at these 5 also again. This is with respect to liability. But remember, you must understand what gave rise to that liability, similar to what we did under assets. You must also now understand what does the tax law require or says about the treatments. We now marry these 2 understandings together in order to ascertain the tax base. 2 minutes. Sorry. Okay. Now let's move further. Now let's look at the first item there. Current liability include accrued expenses with a kind amount of 12,000 naira. Therefore, the question is, what brings about accrued expenses? What brings about accrued expenses?
It means that services has been rendered, but the actual invoice has not been received.
I think, not to add to that, I think you services have
Okay,
been rendered
or
goods have been, let me just, I was saying something. Okay, or goods have been, the service have been enjoyed, invoices have been received, but payment has not been made. I think that is the way I see it. Accrued expenses.
And accrued expenses, is that correct?
No, it's not about payment. It's about you are certain that the services has been enjoyed, but the invoices for that services has not been received. Therefore,
no, it's about payment.
I think it's the payment, it's not the invoice. You have enjoyed the services, but you have not paid for.
Not paid, yes.
Okay, I would like to add to what they've said. I think accrued expenses, they are the usual expenses that you incur, maybe the usual professional services that you need, and you are certain that you are going to need them. For instance, maybe auditing services or service of a lawyer. And you know that in the coming year, just as you did in the present year, you're also going to need that service in the coming year. So you accrue for it in the present year.
Okay. Now, I think even though I'll jump the gun here, but again, to be able to allow us to move further, I think we need to understand that liability can come in three ways. I use this triangle to describe what a liability is. Okay. Liability. Now, liability can be payable. Liability can be accrual. And liability can be provision. Who can distinguish between these three?
Okay, can I
when
just...
is a liability payable? When is a liability accrued for? And when is a liability provided for?
Okay, let me say something on these three. Can I go on?
Yes, sir.
Okay, for the payable, they are it relates to expenses that have been incurred and not paid for, or services incurred or goods received that have not been paid for. So it's a payable. It's a liability that is payable. Therefore, accrual is income that you have received, but you have not earned for this period. Is income that relates to the preceding. Hello? Hello? Liability, yes. It's a liability if you receive a rent last year's, next year's rent this year. It's an accrual, but it's a liability. It's a rent for next year, but you have received it this year.
I think I'm missing that.
Hello?
That can be accrual.
That can be accrual. Hello?
Yeah, that can be accrual.
Okay. Okay, for provision.
think it's freeze.
Let me just on our provision. The provision is a liability.
Okay, I think his network is bad. Okay, who else want to talk about that?
Hello,
Your network is bad. Who want to speak about that?
Okay, let me try.
Okay, Babajide.
I think payables are just services or goods you have enjoyed that you have been invoiced and you have not paid for it. Okay.
Hello?
Accruals are also that you have enjoyed them, but you have not been invoiced for such services or goods that have been delivered to you, which you have enjoyed. So you need to actually create an accrued for it, saying that despite the fact that they've not invoiced me, I cannot just overlook it like that. Need to make accrued for it. Then you take it as a liability. Then provision is a future liability that you're actually expecting, that you are certain that you are going to incur it in the nearest future. Then you make a provision for it that's when it will be incurred. Then we can pay for it.
Okay, thank you very much.
Come here, sir.
Yeah.
Okay. Okay, so the major differences between accrual and provision is that both of them are liability, right? Services has been enjoyed, but you have not received invoice, but you are certain that I've enjoyed this service. So you can accrue for those services because you know the exact amount and the exact amount of that particular invoice, even though it has not been received. You accrue for it. And this is common with recurring expenses, security fees and professional fees and what have you. For provision is just an estimate. Services has been enjoyed, but you don't know the exact amount of how much it's going to cost you. So you can just make an estimate in your books based on certain criteria. Both accrual and provisions are all payable. They are all liabilities that have been incurred and not paid for. Thank you.
Okay. Invoice creates payable. Whenever you have enjoyed a service or you have purchased an item and you have received invoice for it, you know the identity you are paying to, you know the amount you are paying, you know when it is due. Everything about it is certain. Certainty. Therefore, you create payable. But you create accrual where invoice is yet to be issued. But there's a degree of certainty of the amount involved. What does that mean? Let's assume you consume utilities. And let us say the utility is like a fixed rate. For example, an example of a fixed rate utility you consume is waste disposal. In Nigeria, they don't measure waste. They just tell you for this building where your office is accommodated, every month you have billed 5,000. That is the rate by the local government or by the PSP or any agency involved. But they've not brought invoice to you. But you are aware that your office is not littered. Somebody is responsible enough taking away the bin. which means at the end of the month, regardless of whether they bring bill or not, what do? You accrue for that because you know you have such a liability, even though it's not payable until you get what? An invoice. Therefore, you accrue for that. Another example is the one that is not fixed. Such utility might be electricity bill. Unfortunately, you don't have a prepaid meter. But what you have is a postpaid meter. What's a postpaid meter? It reads, and at the end of the month, the PHCN people will come and take the reading. And therefore, bill will come at a later date. But you know your rate of consumption. Your rate of consumption is what is in the meter, which you can go and measure that last time upon reading it was 201. This time it is 249. Therefore, I've consumed 48 units. And you all know what the rate is per unit. Therefore, what do? You use that basis to accrue and estimate what your liability is by the time the invoice comes, which means that is accrual as a liability. Provision has nothing to do with invoice. Provision has nothing to do with consumption. Provision has nothing to do with the issue that you purchase something from someone, but rather provision comes with uncertainty. With respect to amount or timing. We are going to discuss this one and get to IS 37. Now, provision only comes to take care of a liability that could likely crystallize as a result of something that is probable. What does that mean? Because you sell a technological product, you've given warranties, and you know that nothing is 100% perfect. If you turn out 1,000 items that you produce, technological device, experience in the past might have shown you that at least 1 to 5% of it might come back for repairs or defects. And in that situation, what happens? What happens in that situation is that you need to provide for such in case it happens. And on that basis, you make provision. Another thing you make provision on is litigation liabilities. Now, in litigation liabilities, what comes or what is involved is that you have a case in court where you are being charged for the possibility of having a liability. But you are contesting in court that you are not liable. But court judgment has more or less is a two-way thing. It's like two sides to a coin, which implies that it is possible that the judgment can go in your favor or can go against you. Therefore, the probability is there, and you also make provision. Or you recognize that this liability will exist, but the amount involved is what is in contention, that yes, we know we are liable, but you can't charge us 50 million. What we believe reasonable we need to pay is 1 million. Therefore, it's not left for court to decide. Therefore, that is when you make provision. But all of them still point to a direction that they are liabilities. And that is what is required at this point. Now, on that premise, we'll go back to it, which means What is an accrued expenses in all our discussion? Current liability includes accrued expenses, which means probably we have enjoyed a service, let us say utility. And that utility, we've estimated what it is and we have accrued for it. Expense it to our profit or loss to reduce our profit and recognize a liability in our balance sheet. But from the angle of the tax law, we are told that the related expenses will be deducted for tax purposes on a cash basis. What that signifies is that since that expense will only be recognized for tax purposes on the cash basis, it means here you accrue for it, it will have no tax consequence. Therefore, in that situation, for that year, there's no expense for you to deduct against tax. And in that situation, the tax base of such an accrued expense is zero. Similarly, you have current liability, which include interest revenue received in advance, and of which its kind amount is 14,000. What that signifies is that you have interest revenue that you have received in advance. Somebody has paid you interest in advance, which you have not earned. Now, what do? You don't take it as income, rather, you recognize it as a deferred income, which is a liability. But we are told that the related interest revenue was taxed on a cash basis, which means last year it was taxed. Which means this year that we are recognizing the revenue, it will no longer be subjected to tax. Therefore, our tax base will be the kind amount, which is 14,000, less the amount that will no longer be subjected to tax, which is the same 14. 14 minus 14 will eventually give you 0. Again, we have current liability, which include an accrued expenses to the kind amount of 1,000. But in this case, as against what we have in scenario 1, in this case, the related expense has already been deducted for tax purposes, which means the same way we deducted it for accounting purposes by recognizing such an expense has been incurred, is the same way it is deducted for tax purposes as it was recognized in arriving at taxable profit. Therefore, in that situation, there shouldn't be any difference between accounting principle and tax requirement. At that point in time, the tax base and the kind amount are the same. The fourth one says, current liability include accrued fines and penalties with a kind amount of 5,000. Fines and penalties are not deducted for tax purposes. You are all aware that these are things that give rise to a permanent difference. Remember, we discussed permanent difference. If you can remember, let me show you in our notepad here. We discussed permanent difference last week. And what do we call permanent difference? Okay, we said here that kind amount will equal tax base where there's no temporary difference. I would say this situation occurs when where there are differences in tax and accounting treatment of transactions, but these differences are permanent in nature. They are permanent in nature because at no point will you in the future be able to enjoy tax benefit on a fine and penalty that is expressly disallowed by tax law. It's not that it is allowed for you to enjoy it when you pay. It is whether you pay or you don't pay, penalty and fines relating to your taxes or relating to anything that is instrumentality of the law will not be acceptable for tax purposes, which means such difference is permanent in nature. Therefore, what do? We find out that the tax base and the kind amount will invariably be the same. That's why it is 5,000 equal to the tax base. Finally, loan payable has a kind amount of 13 million. And when you repay the loan, there's no tax consequence on that. As we have said earlier, where a liability has no tax consequence, the tax base of such a liability will be the temporary difference, not the tax base. The tax base of such a liability will equal the carrying amount, and thereby the temporary difference will be zero. Why is it going to be zero? Because the tax base and kind amount are the same, which means there is no what? Difference as well. And that is why here you find it that 13 million is our tax base for the loan. Okay, thank you. Okay, in that light, I want us to take this as an exercise. I'm going to split you into two groups. Okay, I'll split you into two groups, and your group will answer it and will come out with our suggested answer. Okay, this question 6 is what you guys will answer. And take note, when we come back from the group, okay, our rule stands and it is compulsory that we must all turn off our camera. Going forward, the administrator at the back end may exit you from the section and not allow you in if your camera is not put on. Okay, please, let us take note of that. You might be taken off and you might not be able to continue the session for the day. Okay, please let us put our camera on at all times. The only person that can be putting on and off is the allowance given to the nursing mother when she's to attend to the baby. Please let us do that. Immediately we come back from our, from our breakout section. Compulsorily our cameras must be on. Otherwise the group administrator at the back end will take you off. Okay, thank you very much. Now, I believe you have this, and I can also share it on the, I've shared it before, and it's also on our WhatsApp page. But again, I'll share it again for you to download so that you can be able to have something to make reference to. Okay, you can download it, it's already on the chat box, and or you can reference it from our WhatsApp page. Okay, now we'll go into our own section, breakout session for 10 minutes, where we are going to come up with an answer for this problem. Now, we are going to look at question 6B. 6B. 6A is what we have just discussed, and it has taken much of our time. And it is good because we have laid that foundation going forward, because without this foundation, we cannot move forward in our ascertainment of deferred taxes. Okay, now I'm putting you guys in a breakout section now. I've opened the room, you can join. Okay, welcome back. I'll leave it up to Group 1. Who is representing Group 1 to provide answers to these 8 questions?
Yes, Nuruddin is
Nuruddin, yeah.
representing Group 1.
Okay, Nuruddin, can you go ahead?
Okay, for number 1 question, I will not read the question. I will just read our solution and the reason for coming up with the solution. Okay, number 1, the tax base will be 15,000. The tax base will be 15,000 because the transaction of assets is taxable. It will be 15,000. Number two, interest receivable as a current amount of 3,000. The related interest revenue will be taxed on a cash basis. In that regard, the tax base of the interest revenue will be nil. Because there won't be any future tax consequence on the transaction. That is why in our group we agree that the tax base for this will be nil. Then number 3, the trade receivable have a carrying amount of 25,000. The related revenue has already been included in taxable profit. On that note, the tax base of the trade receivable will be 25,000. Okay, the tax base for this transaction will be 25,000. For number 4, a loan receivable has a carrying amount of 10 million. The repayment of the loan will have no tax consequence. In that regard, we agree that the tax base for the loan receivable will equally be 10 million because the tax base will be the same with the carrying amount since there is no tax consequence in that transaction. Then current liability include accrued expense with a current amount of 12,000. The related expense will be deducted for tax purpose on a cash basis. On this note, the tax basis will be nil. And our reason for coming up with this solution is that since the tax and the transaction use different approach, meaning that the liability uses accrue basis, while tax adopted a cash basis. Invariably, the tax base will be nil. Okay. For current liability include interest revenue received in advance with carrying amounts of 14,000. The related interest revenue was taxed on a cash basis. On the same note, the tax base for this will also be nil because there won't be any future tax consequence on this transaction. Okay, next, the current liability include accrued expense with a carrying amount of 1,000. The related expense have already been deducted for tax purpose. Invariably, the tax base for this transaction will be 1,000 because we've agreed that when the carrying amount and tax base will be the same. Meanwhile, there won't be any future tax consequence on this transaction. Number last, the tax base will be 5,000 on this. The same reason that there won't be any future tax consequence on the transaction since the tax, since the penalty will be deducted. Since the penalty can be recognized as an expense, but is not applicable for tax purpose. Thank you very much.
Thank you very much. Really appreciate your contribution as a group. Group B, who represents you? Group B, who represents you? Don't be intimidated. Group B, where are you? Who's representing Group B?
Yeah, I'll go for it.
Okay.
Yeah, thank you. The first one, we agree that it will be 15,000 because we are going to remove the capital allowance of 5,000 from the cost of the assets of 20,000. And since the benefits as a result of the assets will be taxable, which is the revenue generated by using the plant is taxable. So that indicates that the cost, I mean, the carrying amount of the assets will be equals to the tax base of the assets. So the second one, interest receivable has a carrying amount of 3,000. The related interest revenue will be taxed on cash basis. Interest receivable. So in the current year, there will not be any tax consequence on the 3,000 because the tax is in the coming year. So our tax base for the second one would be interest related revenue will be taxed on cash basis. So the tax base will be nil also. So the third one, trade receivable have a carrying amount of 25,000. The related revenue has been included in taxable profits. So this shows that the revenue associated with this trade receivable has already been taxed. So in the current year, it will also be nil. The tax base will be nil. So the next one, a loan receivable has a carrying amount of 10 million. The repayment of the loan will have no tax consequence. And when there's no tax consequence, the carrying amount of the receivable will be equal to its tax base. So it will be 10 million. So the next one, current liability include accrued expenses with a carrying amount of 12,000. The related expenses will be deducted for tax purpose on cash basis. So it's an accrued expenses. So when it's an accrued expenses, it means the tax consequence will not be in the current reporting period. So the tax base will be nil. So next, current liability include interest revenue received in advance with carrying amount of 14,000. The related interest revenue will be taxed on cash basis. revenue received in advance with carrying amount of 14,000 naira. So that is a liability. I will skip this one and go to the next one. Current liability include accrued expenses with carrying amount of 1,000 naira. Related expenses have already been deducted for tax purpose. I remember in our group, we still said that this will be 1,000 naira, the tax base will be 1,000. So that is second to the last. And finally, current liability include accrued fines and penalties with carrying amount of 5,000. Fines and penalties are not deductible for tax purpose. So since fines and penalties are not deductible for tax purpose, that means there's no tax consequence. And when there's no tax consequence, the carrying amount of the liability will still be equal to the tax base. So we go for 5,000.
Thank you very much. Thank you very much. Thank you very much. The first thing is that areas of agreement, I try to see whether you guys are collectively right or collectively wrong. But fortunately, you are collectively right for areas in which you had the same answer. Where you guys only have different answers in two. One, you have different answer. The other one, group two, was unable to answer that question. Now, let me see what it is. I'm only going to focus on the areas to which you have different answers. Trade receivable had a kind amount of 25,000 naira. What it simply means that you made sales of goods and you have recognized it as an income and as an asset. Now, the revenue has already been included in taxable profit, which means there's an alignment between tax requirement and accounting principle, which speaks to the fact that at that point in time, the tax base and the kind amount should be the same. And if they are the same, it's supposed to be 25,000. And finally, current liability include interest revenue received in advance, similar to you receiving rent for 2 years, of which for tax purposes, they've taxed the two amounts. Okay, but for accounting purposes, you only account for it in the current year, and the other part was deferred as a liability. Now, the related expense will be deducted for tax purpose on a cash what basis. Okay, what it then means is that your tax base for a liability is the kind amount of that liability, which is 12,000, less amount that will be deducted in favor of that liability from your future taxable profits, which is that 12 million, or because it can be taxed again. In the year in which it's supposed now to be subjected to tax, it will be exempted. Why? Because it has suffered tax at the initial stage. Let me show you again. Remember, we said we are going to take it out. Income earned but not yet received. Okay, now that's income. Where is it here? That we take it off. Okay, income that has suffered tax and will no longer be subjected to tax in the future period. What you do in the future period when it crystallizes is that you don't subject it to tax again. But in the current period, it has suffered tax. And in that situation, what then happens? Go back to our slide. Go back to our slide. We'll now have to show that such tax base will be nil. Why is it nil? It will be carrying amount, which is it 1,000? 14,000? Less amount that will be deductible from future taxable profits. And amount that will be exempted is also 14 because it has been taxed last year. Therefore, it can be taxed this year again when it is now recognized. Therefore, what does that give us? It gives us nil. And that's where the difference lies. Does that make sense? Now,
Yes.
congratulations, group 1 and group 2, but kudos to group 1 for, I think group 1 scored, you got it all, Abby?
Yes, yes.
You got it all. Okay, congrats. Thank you very much. Now, that will lead us to continuation of our discussion. Recall, there are questions we require an answer for us to understand deferred tax. And what are the questions again? Let's go back to it. What is a temporary difference? And I think we have done justification to that. When is a temporary difference taxable? We've done justification to that. Okay. Now, we've not done justification to this. How is deferred tax liability and deferred tax asset determined? Yes, we did a preamble, which I will show you, but we need to justify it. What tax rate is applicable? We've made justification to that. And finally, what is a tax base? We've made justification to that. Now, the only one left out is this, which we have to consider now. Yes, we have looked at it before, which is this. Okay, let's not justify it here. Now, how do we determine deferred tax liability? Deferred tax liability equals the tax rate. You now know the tax rate that you can use, multiplied by the taxable temporary difference. What you get in this case is what we call the deferred tax liability. That's how simple it is. Now, since we know the tax rate applicable, since we know what constitutes our taxable temporary difference, therefore, when we apply the two together, anything that results from it is our deferred tax liability. Whereas for deferred tax assets, how do you do that? Deferred tax assets equals our tax rate multiplied by our deductible temporary difference. Now, it doesn't stop there. There are other things that create assets, which is a future tax savings for us. And one of them is where we have unutilized tax losses. That is carried what? Forward. And if you remember, let me share the screen. Remember that there is a possibility that we are unable to relieve all of our losses in this year. And any portion that you cannot relieve this year, you are allowed by law to carry it forward to next year. The portion that you can carry forward to next year from your tax losses, which will be used to reduce future taxes, will give rise to a deferred tax asset. Remember, in our explanation here, when we're explaining what is a deductible temporary difference, we said it here that when is temporary difference deductible? We said temporary difference is deductible if the difference will result in a reduction in amount of taxes in the future periods as a result of current period transactions. Now, you find out that unutilized tax losses is also a component of a deductible temporary difference, which is different from what we get from asset and liabilities, comparing the carrying amount and tax base. That is why here also we are saying that apart from the conventional deductible temporary difference, another thing that increases the deductible temporary difference, which resulted in additional amount of deferred tax asset, is the unutilized tax losses that is carried forward. Finally, plus tax rate multiplied by unutilized tax credits carried forward. Now, where do we have that? I share the slide again. Remember, we talked about capital allowance. We said a situation where our capital allowance we are unable to absorb all of it in the current year. And the portion you are unable to absorb in the current year will be carried forward to the future year. And in that case, that will give rise to additional deductible temporary difference, which will give rise to what I have on my screen. Let me share it. Which is deferred tax assets, which means three things will give rise to a deferred tax asset recognition when you apply the relevant tax rates. What are they? Deductible temporary difference, which you get from differences from carrying amount of asset and liabilities and the tax basis. 2, from unutilized tax losses that were carried forward, not losses that has expired or elapsed, but those that are still going to be carried forward by law to be enjoyed in the future period. And likewise, unutilized tax credits by law that's allowed to be carried forward, such as capital allowance carried forward. All of this is what gives rise to deferred tax asset recognition. Any question at this point?
Please, I just explained the taxable temporary difference again. That's for the deferred tax liability. You try to, you've explained deductible temporary.
No, we have done that last week. I'm only making difference. Taxable is the temporary difference that will expose you to higher taxes in the future, which is what we said there. When our temporary difference is taxable, they are taxable if it will result in higher taxes in the future periods as a result of current period transactions. And we gave scenarios of which give rise to taxable temporary difference. The first scenario is where the kind amount of your asset seems to be higher than the tax base of your assets. The second scenario is when the kind amount of your liability seems to be lower than the tax base of your liability. These two instances will always give rise to a taxable temporary difference. Does that make sense?
Yes, sir.
Okay. Now let's move down. I gave an assignment or a task. Let me share the task again. And I want us, somebody that have done it, should guide us through before I can make my own contribution. This information there. Okay, information, question 4. Can somebody read it out? Wally, can you read it out? Question 4, and somebody should volunteer to answer.
Question 4. A plant purchased at cost 500 million. Tax depreciation to date has amounted to 220 million naira. And depreciation charged in the financial statement to date is 100 million naira. The income tax rate is 30%. Required. Which of the following statements is or are most likely to be correct in accordance with IAS 12? A, the provision for deferred tax in relation to the assets is 36 million. B, the tax base of the asset is 280 million. C, there is deductible temporary difference of 120 million. D, there is taxable temporary difference of 120 million. That's question 4.
Okay, who will assist us here?
Let me just try.
Okay.
I'm just looking at that number D. Number D says that there's a taxable temporary difference of 120 million. I think that is actually correct because for depreciation, for tax purposes, there is 220 million has been deducted for tax purposes, but for financial statement, the own depreciation is 100 million has been depreciated by 100 million. So there's a difference of 120 million. So that will give rise to a taxable temporary difference of 120 million. That is my understanding from that.
Okay, is that the only thing that is correct? Because I think the statement says which of the following statement is or are most likely to be correct, which means is it only one that is correct or there are more than one that is correct?
Oh, I was just looking at that.
Now, let's look at it like this. Let's extract this information out. Let me try and cut it. Let me crop it out. This is a question. We have a plant which cost 500 million. He has enjoyed accounting depreciation of 100 million. He has enjoyed tax depreciation, which is otherwise known as capital allowance, of 220 million. We are told that it has a tax rate. What's the tax rate? Let me check. The tax rate is 30%. Now, let us now analyze it. First, a plant is what? Is it an asset or a liability?
An asset.
An asset.
Okay, we must take note. That means we are trying to compute deferred tax on an asset. That's number one. Number two, what is the kind amount of the assets? In this case, because you understand the nature of the plant as a PPE, the kind amount in line with IAS 16 will be the cost minus accumulated what? Depreciation. The cost is 500 million. And depreciation enjoyed so far is what? 100 million. Which means the tax, the kind amount is what? 400 million naira.
As base.
Now the next thing is, what is the tax what? Base. Because we know the nature of this asset as a qualifying capital expenditure.
Yes.
The tax base is equivalent to the tax written down value.
Yes.
And what is the tax written down value for a qualifying capital expenditure? Is the cost minus capital what? Allowance. Enjoyed, Abby? Okay, what is the cost?
500
million. What is the capital allowance enjoyed so far? 220. What is the tax base?
280. So if the current allowance is
now, the question then is, which is correct? Is the current amount greater than the tax base?
Yes.
Or is the current amount less than the tax base? Which one is it?
Greater
than
the tax base.
Okay. It's greater, Abby? Therefore,
Yes.
let us mark it. This is correct. This is what? Wrong. Abby?
Oh. Yes,
okay.
sir.
If that is the case, what is the temporary difference? The temporary difference
120.
120.
is kind amount of 100 minus what? 280.
280.
Not?
120. Yes.
120 million.
Yeah.
This 120 million, is it taxable or deductible?
Taxable.
Taxable.
How do we know? I told you that you can. In this case, we are dealing with an asset.
Yeah.
And
Yes,
the amount of that asset is greater than tax base, which means where does this meet this? They meet at this point. Abi? Is that not?
Yes, it is.
Therefore, we say in this scenario is a taxable temporary what? Difference. Now, given tax rates to be 30%, therefore, if you apply this 30% on 120, that is, if you multiply tax rate by taxable temporary what? Difference. It means 30% times what? 120 million will give you approximately 36 million. This 36 million is a deferred tax because we have applied tax rate on the taxable temporary difference. But is it a deferred tax asset or a deferred tax liability? What is it?
Asset.
Eh? What deferred tax is it? Asset or liability? I can't hear an answer.
Asset.
Applying tax rate on taxable temporary difference, what will it give rise to?
Deferred tax asset.
Asset now.
Deferred tax liability. How can it be assets? That means some of us are not paying attention. First, I've explained what taxable means. Taxable means it gives rise to more taxes. Taxable means it reduces your taxes. Therefore, what reduces your body is an asset. What increases your body is a liability. Secondly, we also just discussed it now, that what? Deferred tax liability is arrived at after multiplying tax rate with what? Taxable. Whereas deferred tax asset is after multiplying with what? Deductible, plus what? Unutilized tax losses carry forward, plus what? Unutilized tax credit what? Carry forward. Okay. And that also speaks to our diagram we gave here. If you remember, when we started the class, we said taxable temporary difference will result in deferred tax liability, while deductible will result in what? Deferred tax assets. What will make them result in that is the amount of our tax rate, which we've now defined what tax rates stand for and which form of tax rate is applicable. Any question at this point? Now, if we go back to the answer from what we have here, if you go back to the answer, which of these following is correct or are correct? Yeah, let's pick it one by one. Is A correct? The provision for deferred tax in relation to an asset is 36 million. Is it correct?
Yes.
Yes.
What are they saying there? That is, you recognize deferred tax on that asset. Which asset is it? Hello? Hello? Okay, let's B. The tax base of the asset is 280 million. Is it correct?
Yes.
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 There's a deductible temporary difference of 120 million. Is it correct?
No.
Why is it not correct?
Because it's taxable.
Yes. Now that there's no temporary difference of 120, but that temporary difference is not deductible, rather it is D, which is taxable. Which is the options that are correct are A, B, and what? D.
And B.
Okay, now I'll give you this tax for individually for us to do it in 5 minutes. Question 10. I will enlarge it in 5 minutes. Let us attempt it. Question 10 in 5 minutes. Okay, now not to attempt it. Gerard Limited start business on 1st of January 2015. In its first year, it makes accounting profit of 30 million after charging depreciation of 4 million naira. The tax depreciation or capital allowance granted in the first year was 6 million naira. The cost of the plant was 20 million naira and the income tax rate is 30%. The first question, we are told to compute the deferred tax for the year ended as for December 2015. The second question says we should compute the current tax for the same period. And the last question says we should determine the income tax for the same period. What do we do in this case? Now, the first question, we had a plant. We have a plant, which is an asset, and it costs 20 million naira to acquire. Now, we are told that the carrying amount of the asset for tax purposes will be in line with IAS 16, and that is cost minus accumulated depreciation. The cost is 2 million, and depreciation charged so far is 4 million. That means the carrying amount is 16 million. The tax base is equivalent to the tax written down value for a qualifying capital expenditure, which is the cost minus capital allowance enjoyed. What is the cost? 20 million? What is the capital allowance enjoyed so far?
6 million.
6 million. Which is what? 14 million. Now, there's a temporary difference. Of how much? 16 million minus 14 million, which is what? 2 million. This 2 million, is it a taxable temporary difference or a deductible temporary difference?
Taxable.
Taxable.
Given that it's an asset, and secondly, given that the kind of asset is greater than tax. Therefore, I'll say this is what? Taxable. Temporary what? Difference. Now, if we apply tax rate, which is 30 what? %. Therefore, I recognize deferred tax liability of what? 30% of how much? 2 million. Invariably, that should give me 600,000 naira.
100,000.
Now, this is deferred tax liability as at 31st December 2015. But what we are told to determine is deferred tax for the purpose of income or statements. Now, what that means, I need to look for movement in my deferred tax liability. In the year. What does that mean? It means I'll compare my deferred tax liability at the beginning of the year. The balance brought forward, I'll compare it with the balance carried forward. Now, the company just commenced business in that year, which means when a company commences business in a year, it doesn't have any opening balance. Every transaction came up in that year, starting from capital introduced to the business. Therefore, it means there's no opening balance, which means the opening balance is what? Is 0. But as at the end of the year, our deferred tax assessment shows 600,000, which means, is there an increase in deferred tax liability or a decrease in deferred tax liability?
An increase.
An increase, okay, from 0 to what? 600. And what do we say from the angle of conceptual framework? Let me check whether we put it here. When there's an increase in a liability, which gives rise to a reduction in an equity, what does that give rise to? Is it an income or an expense?
Expense.
Expense, thank you. Which is this deferred tax expense. For the year 2015. And that is that. Now, the second question says what? The second question says, calculate the current tax for the year ended. Okay. Current tax for the year ended. Remember, how do we estimate our current taxes? We start with our accounting profits. Is that not? Accounting profits. What's our accounting profit? Accounting profit is 30 million. In this case, they didn't give us taxable profit, which means we have to carry out tax adjustment. Now, what do we do as an adjustment? The only tax adjustment we have here is to add back accounting depreciation. Remember, this 30 million was after depreciation of 4 million was charged. Therefore, I'll add back 4 million. That gives me what? 34. This 34 is what you know as our adjusted profit, or profit accessible to what? To tax, or what we call accessible profits. Now, we'll now deduct capital what? Allowance. What was the amount of capital allowance for that year? 6 million. Okay. Therefore, I deduct 6 million. That give me what? 28 million. And this is my what? Taxable profits. Now, what is my estimated tax? 30%. Is the rate of tax that I was given 30% times 28 million. What does that give us?
8.4 million.
Eh? 8.4 million. Okay, thank you. Now, what is my income tax? Which is C. My income tax expense for the year ended 31st December 2015. Remember, income tax comprises of what? Current tax and what? Deferred what? Tax. What's our current tax? 8.4. But what's our deferred tax?
600,000.
600 expense. Expense and expense will increase to how much? 9,000. And this is our income tax. Now, let me prove something about deferred tax as no tax. Remember, by law, we are to pay how much? 8,400 as our tax. But if you look at our accounting profit of 30 million, if we tax our accounting profit directly and say 30% of that 30 million, it should give us what? 9 million. This 9 million is what we are been able to arrive here at 9 million, which is what deferred tax is trying to adjust for. To say, yes, you comply with the law. You make tax of 8.4 million to FRS, but you account for it as 9 million by creating an accrual adjustment, which we call deferred tax. The essence is that the benefit you thought you enjoy was as a result of the fact that you enjoy more deduction by way of capital allowance than what you're supposed to enjoy by way of depreciation. What that means is that in the future, you will have exhausted all your allowances such that at a later date, there's no allowance to enjoy. The remaining profit will now be exposed to tax, which means not that you have saved anything, but you have more or less enjoyed early enough and you will pay for it at a later what? Date. And in order not to have been deceived in your income statement, to have accounted for tax of 8.4 and share all your distribution as profit and pay it as dividend, what we are saying that no, take allowance, provide for that 900, how much? 600, because by next year or 2 years' time, when it crystallizes, you won't have eaten all your cake at the beginning or the earlier periods. All because if you consider anything other than tax, what is left is your residual profit that is now available for distribution. But what happened is that profit truly available for distribution? The answer is no, because they are component of taxes that as a result of what you have done today, you are bound to pay more tomorrow. And when it crystallizes more tomorrow, how do you take care of it if you have eaten all your future today? And that's why some people view deferred tax as a way of smoothing the profit so that volatility attributable to tax rules does not necessarily impact your financial performance. And that is what we are trying to achieve. But again, as we move on, you'll see more of that. You'll see more of that. Any question? Any question at this point? Who got the same answer like me?
I
got it.
got it.
Yeah, thank you. Any question for those that didn't finish or those that got it wrongly? Babajide?
Yes, comrade.
Yeah. What's your view?
I'm still just trying to understand for instance, when you try to explain the definition of taxable difference, you say when the carry amount is higher than when the carry amount is greater than the base tax base, and is going to result in future.
No, don't miss it. Don't miss it up. There are two ways of viewing it, which is what I've put to you here. Okay, is either you use the matrix or you go by these examples which I've given to you. Are you getting it now?
Yeah.
The matrix summarizes it all, okay, and this explains it further. To say, for you to have taxable, this must have happened. And for you to have deductible, this must have happened. And without laboring yourself, once you have this diagram, it explains all what we have described in these two scenarios to you. And that's what we are trying to say. And I will advise you to go back, and I know you didn't watch the video of the session we had last week.
Yes, sir.
Yeah.
This is my question here.
Yeah.
Now, from this screen that you show, you say temporary difference is deductible is that if the difference will result in a reduction in amount of taxes in the future. So how do you identify that the difference will result in a reduction or will result in an increase?
That is why you now look at it that what are the examples for an asset? How do you observe? And for a liability, read it further.
Okay, say for an asset, where the carrying amount of an asset is lower than the tax base of the assets. Okay, if we have a property with a carrying amount of 10,000 and a tax base of 12, then the TD is of 2,000 is deductible.
Because this will give rise to lower taxes in the future. Example of it is that when the capital allowance you charge is lower than the amount of depreciation you recognize, what it simply means is that the law is not allowing you to enjoy capital allowance earlier enough, but you enjoy it at a later date, which then means that not enjoying it earlier enough means you pay more tax now. When you now enjoy it later in the coming years, you will pay lower what? Taxes. That's what we are saying.
Okay, then it's deductible. Okay. Not in amount of taxes in the future. Oh, okay. Results in a reduction in the amount of taxes in the future.
and you have not watched the video again, because last week you gave us an excuse that you are in the program, you are just in and out. Therefore, it's about time you go and watch that 3-hour lecture. And on Sunday also, you missed the 2-hour lecture. Okay?
Yeah, we do that.
Yeah, you have to do that before tomorrow, compulsorily.
Okay, boss.
Okay, now let me share this again with you guys. I want you to solve it in 3 minutes. Question 11. Okay, let's look at this answer and solve it. Let's go back to our note. Who can read the question for us?
Walcott PLC recognizes provisions in accordance with IAS 37 of 1 million naira on its product warranty issued on its sale of a mechanical device made in 2014. In accordance with the relevant tax laws, this product warranty cost, as estimated in line with IAS 37, will not be deductible for tax purposes.
I'll read it. Walcott PLC recognizes provision.
I've started reading already. If you can mute your system, sir. This product warranty cost, as estimated in line with IAS 37, will not be deductible for tax purpose until the entity actually pays for such cost. That is, allows such expense only on a cash basis. The corporate tax rate is 30%. Required, describe the deferred tax implication of the situation.
Now, how do you describe the deferred tax implication of this situation? The first thing we need to take into cognizance is provision in this case. Is it an asset or a liability?
The liability.
Liability.
You need to understand so that you know what are you computing deferred tax on. Is it on asset or is it on liability? Now, that will drive our actions. Now, what is the carrying amount of provision?
1
The
million.
carrying amount is what we have recognized in line with IAS 37 in our balance sheet, which is how much? 1 million.
1 million.
Now, the next question is, what is the tax rate?
0.
Now, you can't come here and say tax citizen value because this is not a qualifying capital expenditure. This is a liability. The question then is, the tax base of a liability is determined as thus. What is the kind amount of the liability? It's 1 million, Abby. Less what? Less an amount relating to the liability, which in this case is a provision that will be deducted against future taxable profits. That amount is X, which we don't know. What is that X? Once you know the X, we easily obtain the tax what? Base. Now, we ask ourselves a simple question. What does the law say here? The law says that in accordance with relevant tax laws, this product warranty cost will not be deductible for tax purposes until the entity actually pay for such. Now, remember, we did an analysis to separate, to define what a provision is. Now, whenever you have provision, it shows that no liability regarding payable has been identified. Talk less of even paying it, which then means that cash has not been parted with when you have provision in place, which means there is the amount that will be deducted in the future is simply equal to the amount of that provision, provided in that future you are able to make payment of it once it crystallizes. And what amount is that? Is that 1 million. Once you deduct 1 million from 1 million, what do you have here? 0. And I think somebody already mentioned 0. And probably the person used the same principle. Which then means that if that is the case, what then is my temporary difference?
1 million.
My temporary difference is the difference between the carrying amount, which is 1 million, minus what? Is 0. And that gives me what? 1 million. Now, this temporary difference, is it taxable or deductible? Who will answer it?
Deductible.
I'll ask again, is it taxable or deductible?
Deductible.
Now, here, a carrying amount is greater than tax base of a liability. Let us take our table.
It's deductible.
This is a liability. And the carrying amount is greater than tax base. What do you have?
Deductible.
Deductible.
Therefore, we come down and say, this is what? A deductible
Temporary
what?
difference.
Now, given tax rates to be, what rate is that? 30%. Hence, we recognize deferred tax. What do you recognize? Deferred tax asset or liability?
Which one?
Deferred tax asset or liability, what do you recognize?
Assets, deferred tax assets.
Yes, because deductible will give rise to future reduction, and that brings about economic what? Benefit. And anything that brings about economic benefit is considered to be what? An asset. Therefore, what is the tax rate? Multiplied by what? Deductible temporary difference, which is 30% multiplied by 1 million. What do you have as a deferred tax asset? 300 what? 1,000. And that is it. Which means the question says we should describe. Now, how do I describe it? That having a provision of 1 million naira in which the tax law will only allow for deduction on a cash basis will give rise to the recognition of deferred tax asset of 300,000 naira. That's just it. Any question at this point? Any question at this point? Now, what we have simply done is that we have laid the foundation. We have laid what? the foundation, which means at this point, if we go back to the starting point, we've answered the questions. All of the questions has been successfully, meticulously answered, which then means that now we should understand what deferred tax is. Once we assume we understand what deferred tax is now, we can now move further to the advanced level of deferred tax. And moving further to that advanced level means that I'll give you this tax in which we'll continue from tomorrow. And what is the tax? The tax is as written here. Okay? I want you to go and look at these two taxes and revert with the answer. Question 12 and question 13. Can you read question 12? I'm coming. I want you to read question 12 and question 13 before we close for today, because that is the tax that is being given to you. Okay, yes. Ifechukwu,
Okay.
go ahead.
Paramola PLC starts a business on 1st January 2011 with an initial capital of 1 million invested in the acquisition of plants for its operations. The activities of the company in its early stages are minimal, of which accounting profit for relevant years 2011 to 2014 are fairly stable at the sum of 400,000 naira per year. The accounting profit was after all operational costs, including depreciation, have been charged. The company's depreciation policy requires a straight line basis of cost allocation. The Inland Revenue Service requires the cost of the plants to qualify for capital allowances, that is tax depreciation of 50%, 30%, 20% on cost for year 1, year 2, and year 3 respectively. The corporate tax rate is 40% and has remained unchanged. Required, determine the following: current taxes for relevant periods, deferred taxes for relevant periods, income tax expense or income for relevant periods, effective tax rate for relevant periods. Question 13. Assuming question 11 above, but as at the end of the year 2012, that is 31st December 2012, the IRS announced a change in tax rates to 30%, commencing from period beginning 1st January 2013. So please, the screen.
Okay, yeah. Can't you see it?
The screen, I can't see the rest of the questions.
No, the question ends in question 13.
Oh, okay, that's it.
Okay, no, okay, I think I'll add 14 to it. Let me go to the screen. I'll add 14 to it. Yeah, okay. Continue.
Paramola PLC starts a business on 1st January 2011 with an initial capital of 1 million invested in the acquisition of plants for its operation. The activities of the company in its early stages are minimal, of which accounting profit for relevant years 2011 to 2014 are fairly stable at the sum of 100,000 naira per year. The accounting profit was after all operational costs, including depreciation, have been charged. The company's depreciation policy requires a straight line basis of cost allocation. The Inland Revenue Service requires the cost of the plants to qualify for capital allowances, that is tax depreciation of. So please shift the question. Okay.
Okay, I'm coming. No, it stopped at question 14. Can you see it?
Tax depreciation of 50%, 30%, 20% on costs for year 1, year 2, and year 3 respectively. The corporate tax rate is 40% and has remained unchanged. That's all I can say, sir.
And as remain what? Unchanged. Required.
Required. Determine the following: current taxes for relevant period, deferred taxes for relevant period, income tax expense or income for relevant period, effective tax rate for relevant period.
Okay. Now you can go on your chat box and download all the solution we have done to since last week till now, and also the questions are there. Even though you have the questions separately, just download them. I will expect you guys to attempt all of these 3 questions based on your understanding. And also, I'm sending you the note for deferred tax all through my presentation slide, which I'm sending to you now. Okay? Just take note of it. I'm sending it to you now. You can download it. Both documents will be presented also on your WhatsApp group, or you can download them now. Okay? I'll put them on your chat. Any other question before we take our leave? Any question again? Okay. Okay, in absence of no question, we'll call it a day. Thank you very much, and God bless you.
Thank you.
Thank you, sir.